Each time a card is swiped and the quiet beep rings out, a silent system awakens. An intricate dance of digital transactions, bank approvals, and hidden intentions. That small piece of plastic grants the power to take home goods not yet paid for, while banks smile approvingly. But behind that smile lies a series of carefully hidden truths. 7 secrets most consumers never see coming. Miss them, and the next statement might not just be a bill, it could be a trap, sprung without warning. The illusion begins with seductive offers. 0% interest for a year, maybe 2. The fine print doesn't forgive interest, it only defers it. One misstep, even $1 unpaid beyond the promotional period, can unleash backdated interest on the entire purchase. A laptop bought for $1,200, nearly paid off in time, can suddenly be burdened with 18 months of 22% interest simply because the remaining balance lingered a day too long. The bank's strategy depends not on your debt, but on your memory of when the clock runs out. Store cards thrive on this tactic, hiding critical terms in microscopic print beneath bold, festive offers. In the chaos of holiday shopping, precision is forgotten, and the trap is sprung. Then comes the minimum payment mirage. Statements boldly highlight small, manageable amounts, $35 perhaps, designed to feel harmless, like pocket change. Yet those numbers are engineered through behavioral algorithms, tuned to stretch repayment over decades. A $2,000 balance at 19% interest, paid only at the minimum, could take over 12 years to clear and rack up more than $2,700 in interest alone. A system built for profit, not mercy. But a small change, an extra $50 per month, can flip the math entirely, cutting years off repayment and shrinking total interest dramatically. A mere 15 minutes of side income a week could outperform years of compounding debt. Meanwhile, the due date quietly shifts in the background. Cutoff times are often set in distant time zones, and banks know how busy life can get. A payment just minutes late can trigger a late fee and a punitive interest rate that may linger for 6 months. Holiday cycles can stealthily shift due dates into more dangerous territory. But timing is power. Automatic payments set a week early, reinforced by dual reminders, form a digital armor, guarding against sick days, traffic, or a dead phone battery at the worst moment. Unseen by most is the impact of utilization ratios. Credit bureaus judge not what is paid, but what appears on the statement closing date. Even a balance that's paid off a few days later can look like maxed out usage, dragging a credit score down by 50 points or more. The result? Higher rates, tighter lending, and a growing dependence on the very institutions that engineer the fall. But the solution is simple. Clear the majority of the balance just before the closing date, finish the rest by the due date, and the bureau sees only what benefits you. Spread usage across multiple cards, rotate activity, and keep others active with small autopay charges. Over time, your score climbs while the bank's leverage fades. The promise of rewards is another carefully crafted illusion. Cash back sounds generous, but the bank has already benefited by lending your money to merchants and collecting fees. That 1% is mere pocket change from a much bigger transaction. And with many programs, a single late payment or closure can erase all accrued points. Using the card only for essential purchases and paying in full transforms rewards into genuine gains. But chasing them often turns into spending more for far less. Rotating categories offer 5% back for a limited time, capped at modest thresholds. Once the cap is hit, the habit remains, but the reward drops. Then quietly comes the upsell of protection plans. Emails dressed in cheer offer payment protection for under $1 per 100 spent. But this fee, too, accrues interest, and many of these plans exclude gig workers or cap coverage to a few short months. Worse still, some issuers re-add these services after updates, counting on your inattention. A monthly drip becomes a costly leak. Credit monitoring may be bundled in too, masked in a single line on the statement. Unbundling and opting out reclaims control. Federal law already grants you access to free credit reports. No extras needed. Finally, the credit line cliff. One day your limit doubles and it feels like a reward. But it's bait. Higher limits encourage more spending, which earns the bank more fees. Then, when the economy shakes, That same issuer may slash your limit below your balance. Suddenly, your utilization spikes beyond 100%, crushing your score and triggering higher rates across all credit-dependent services, from auto loans to insurance premiums. A single reduction can ripple through your finances in days. The only shield is discipline. Use only a fraction of your limit, ignore seductive emails, and keep emergency funds outside of credit. These systems are engineered, deliberate, and deeply profitable for them. But knowledge, when paired with action, dismantles the trap. Pay early, pay extra, split your payments, read the fine print. Ignore the bait. With intention and vigilance, the same tool they built to bind can be repurposed, to build, to strengthen, and to protect. Thanks for watching InvestingFlix, where smart money learns smarter moves. Subscribe for more insights that grow your wealth.